We're looking at a hypothetical back test of Soybeans Swing, the aggressive version. We're going to talk about that in a minute. I'm going to go over the portfolio results. In April, it was a down month. I have not sent out as many emails lately. I've been buried in code trying to upgrade some of the strategies into NinjaTrader 8. And here you see the results. You can scroll down. You can find the portfolios here, market portfolios. We went to nearly a worst case drawdown. When it's been there before, you see that those low spikes there are worst case drawdowns. And then we're having some bounce back in May, so it's still a good time to get in. It's still in a drawdown and it's bouncing back. So if you want to get in, I always recommend starting in a drawdown instead of an equity peak if you have to choose. And so those are the options that you have in the portfolios. You can see all the results there. Not going to go over all of those. The trades from today, let's take a look at those. Flipped over to my server. You see here's some of the trades for the day. Soybeans is long, exhaust and reverse. This is the 100K portfolio. So exhaust and reverse is long. We haven't had a trade since the 27th of last month, so it's been pretty quiet in the E-mini S&P. Very, very quiet actually. And so it's long today, exhaust and reverse. You see the crude oil after hours hit its profit target this morning. Big, fast move down. Have to always like those. It seems like every time we get a fast move down, you get a spike back up or a move back up. But we got out the profit target, and it was a nice trade. It's been hard to short crude, but it's getting easier. So nice trade in crude oil. And here is a soybeans trade today. We had silver yesterday. Silver was a nice trade for us yesterday on SR counter trend silver. And you see Gold Flash was a losing trade yesterday. It almost hit its profit target on the Fed minutes with 0.8 of a point, and then it got stopped out. So that was the negative of the day. Here is Swing Soybeans. This is the aggressive version we're going to be talking about. I like being long soybeans. Whether that's justified or not, we'll see. But I like being long. I like this market on the long side. We had a nice trade earlier this week on the long side. We held the position over the weekend. On a Monday it went up. So there is a bid in the grains. And what else? The stock indexes are a big part of this portfolio. See, 7 of the 21 trading systems trade the stock index portfolios. Not many trades. Yesterday we had 2. We were long at the close, exited, and the market went up. You see that a lot lately. The market spiked up overnight, or went up about 10 points overnight, came back down now. But a lot of times when you have a long strategy, this is something I'm going to research. When you have a long trade, is oftentimes that long trade, if it finishes near break even, and then you exit it on your day trade, it might be worth taking a look at taking that trade overnight. It's as if they don't want you to make money on that trade. If you see the market as a mechanism for preventing you from making money, it can be a healthy view from a risk management perspective, as long as you don't become too paranoia. But trying to figure out all the nuances of the market, sometimes it's better to see it as an adversary that is trying to hurt you, and how will you stop it from hurting you, and to come up with strategy based on those concepts. But like I said, as long as you don't become too paranoia and take it too personally. So those are the live trades, the most recent live trades from the portfolios. Some of those gap fill and reverse on the crude. Also in Brent and NYMEX was a profitable trade yesterday. I'm on the VPS here, so it's hard to maneuver this around. So those are some of the live trades today. Here is here's my offline trade station with Soybeans Swing aggressive. We have the conservative in the portfolio, but I've personally switched over to the aggressive version, and here is one of the reasons why. Take a look at the average monthly returns. Also, it does not increase the drawdown overall in the portfolio to trade the aggressive version. Hypothetically, in the back tests, it is still more risk. Anytime something trades more in the future, there could be more risk. So even though it doesn't show up in the back test as more risk, it could still be in the future because it does trade more. So here's the reason why. This is the aggressive version. Look at the way it does The first part of the year, it's so-so. 685 and 711 in March on average. And then you get up here to May, 818, 1120 in June, 2000 in July. August is kind of a slow month. 1103.41, and then it's pretty slow in November, break even, and then big again in December. So we're in the better part of the year, starting in May. We're the better part of the year. The first 4 months are not as good as the last 8 for this strategy historically, and this is going back to 2006. So we have 11 years of data. If we had 30, it would be more statistically significant. But for this is the electronic markets, and this is the aggressive version. And you see the performance summary. This is with $25 round turn and slippage and commission, so it's 135 before 135 before slippage and commission, and 110 after on the average trade profit. And our trade today has 1 tick of slippage on the entry. And we use 25. We're looking at averages over time. On slippage and commission, we look at averages. We don't look at worst case scenarios. For example, yesterday in bonds, we had an entry and an exit, and neither one of the entries or exits had slippage. So our slippage on that trade was 0, even though we used $25 round turn on all trades. We find that our average, that tends to be our average, because sometimes it goes for us and sometimes it goes against us. Sometimes we get more than the average, and many times we get less than the average. So that's why we use 25. And so the question of this video, long video here, is turning out to be, is aggressive or conservative. So this is the aggressive version. Now we're going to take a look at the conservative version, and we have an input on this strategy. We set true or false. Aggressive, true. If we want to be not aggressive, we say false. One other thing that we have in this is the custom session goes till 2:15, and now soybeans trades till 2:20 Eastern, and so we may add 5 minutes to that. So there's still 5 minutes of trade after our custom session. So let's take a look at the results. It's going to update here. So here's the updated report. The average trade profit is much higher. You get 196 on the conservative. The equity curve, it hasn't made an equity peak since August of 2016. It's been kind of flat lately. It does that. And so here are the results. Very low drawdown. This is with $25 round turn, slippage, and commission. And on my website, I show you the performance in this strategy back to 1984 in the pit markets. And so we have pit data back to 1984. So there's a lot of good confirmation that this is a good strategy to trade. And these are hypothetical results. And that is the update. And you can decide this. I want to show you this real quick. Here is the average months. So just not as much. Just don't have as much profit. So if you're going for profit and you don't mind the extra drawdown, you might want to go aggressive. And if you want to go with the conservative approach and lower drawdown, you can certainly do that too. So that's the difference between the conservative and the aggressive approach for trading soybeans swing.